that was able to join us today in this webinar. This is now our fourth webinar in the series, so it's exciting to engage with the community and generate this content. And we always welcome feedback and hope to improve on this so that we can better serve you, our audience. So without further ado, let's get rolling here. So as Michael mentioned, I'll just start with kind of a small business overview, some of the fundamental things to keep in mind, and then we'll delve into kind of the core of this webinar, which is around cash flows and the cash flow statement. So if you're starting a small business, you need to think about building a viable business plan. You need to think about your cash flow projections, which will also be a part of that business plan, and we'll discuss in depth in this webinar. You need to think about registering your business and funding sources. Where can you access loans, equity, grants, if you need external funding to help you get started. So in terms of a business plan, we covered this topic in more depth on a previous webinar that I helped lead, and hopefully we'll have that up on the Access website fairly soon, and you'll be able to listen to that. But we've also got a business plan template available on the Access website. That's under the Resources tab, Tools and Templates. And in general, just to kind of review some of the things we talked about in the previous webinar on business planning and market research, we talked about kind of the first steps of business planning before even kind of delving into building the plan itself, is just thinking through sort of the fundamental questions you need to ask yourself before starting any business, like what exact problem am I trying to address? Are there already players or competitors out there in the market that are helping solve this problem? What can I bring to the table that is unique and is not currently being offered, or maybe is being offered in a different way? And how can I start validating some of the assumptions I'm making about how much customers are willing to pay for this service or product? How much do they really want it? How much of a problem is it really for them? So those are kind of the first steps. And then thinking about your business plan, we spoke in that webinar, we spoke about the business model canvas, which is kind of a quick and dirty way to think about your business plan in one page, and just to highlight some key questions and some other things you can start testing with your customers and things you can start validating. And then of course the full business plan, which is the template I mentioned we have up on the website, and that's what you'll need if you'll be applying for a loan with Access, or many other programs that offer grants and loans will likely require this as well. Business registration, this is available through Service Ontario, either online or in person. Always advise to register your business unless it's a sole proprietorship that actually carries the same name as your own name, in which case you don't have to register a business, but otherwise you should do it, and you could get fined if you don't for operating an unregistered business. Service Ontario also allows you to check to make sure that your business name is not already being used by someone else, as you don't want to end up in a situation where somebody is suing you or coming after you because you've kind of copied their name. So it's one thing that's good to check. Not too expensive in terms of setting up, $60 if you register your business online, and $80 if you do it in person. Once you complete the registration process, you'll receive a master business license, and that will be valid for 5 years, at which point you'll need to renew that. Financing your business. So this actually ties quite well with the talk about cash flows, because part of what we'll be talking about in this webinar is the business setup stage, kind of that first stage, and what do you really need to have in place to get your business started and start generating that first dollar of revenue. And if you don't have what we call self-financing, perhaps your own savings or your own lines of credit, maybe family wealth that you can tap into, then you need to think about external funding. And so this slide just shows what are some of the options out there in terms of external funding. So those include grants, usually government funded. The Government of Canada has the Innovation Canada website, which lists various grant programs that you can apply for, and some of those are actually targeted specifically for disadvantaged communities in Canada, whether that's newcomers, individuals living in rural areas, women. So definitely something to look into, as grants typically don't carry any requirement to repay the money. There's crowdfunding, which has gotten increasingly more popular with social media now. So for those who are unfamiliar, this is sort of setting up a profile, describing what your project is, setting a target for how much you're looking to raise, and then basically aiming to raise small amounts of money from many different people throughout the network. So that's one option as well. And then, of course, loans, whether that's through traditional channels like banks or organizations like ourselves, Access. There's also an organization in Toronto called Futurepreneur. And then we've got angel investors, which are kind of these more exclusive networks of high net worth individuals who are looking to invest in promising entrepreneurs. And usually that requires, some sort of special introduction or a connection to a network. So those were kind of the basics in terms of starting a business. Again, if you're interested in any of those specific topics, we do have other webinars and recordings, which will go up on our website soon, as well as sort of presentations we do in the community about various topics. So, and we're always happy to answer questions about those topics as well. But let's turn to kind of the main focus of today's webinar, which is around cash flows. So just starting with some basics, why do we care so much about cash flows? Why is it something that's important to know and learn? Well, ultimately, as we say in business, cash is king. And it doesn't matter if you have a really great product or a great service, and you're the best entrepreneur, the best fit for that business. If you're not managing your cash appropriately, ultimately your business will fail. So this is really, just as a first critical point, cash management is absolutely critical. Cash planning is also really helpful for making business decisions. We talked about setting up your business and how much money you may need to get started. So this will help you decide whether you need to access external funding and when might you need that. So we'll get into the specific details of how we can think about budgeting our setup costs. But that's a critical decision that planning your cash flows will help you address. Other questions like, can I afford to hire employees? And if so, how many? Perhaps you're really excited about how your business is doing and you really want to grow it. And in order to grow and generate more revenue, you need more staff. You need to think about whether you'll be able to pay those salaries when your staff just join you. Perhaps you need to take a gradual approach and be able to generate some profits before you have enough cash to pay staff. How much inventory can I afford to buy right now? You don't want to end up in a position where you tell a supplier or a vendor that you're committing to buying a certain amount, when in reality you don't really have that cash in the bank account to buy all those products, and then you ruin a relationship with a supplier. So again, very important for making business decisions. Also very important for monitoring the performance of the business. So we can look at how our business is doing and compare that against our business plan and start asking questions. Why am I not generating the revenue that I thought I would be generating this month? Or, who are my most important customers? Where's most of my revenue coming from? Perhaps I can identify a specific product or service that is generating most of my revenues. So tracking our cash flows is very helpful for understanding the performance of our business. Tracking our cash flows also helps us monitor who owes us money and who we owe money to. So sometimes when we conduct business, not every transaction is done on a cash basis, meaning maybe, so one example is professional services. When somebody is an accountant or a lawyer, you may provide the service to begin with and then only bill the client at the end of the assignment or the project. So you kind of need to keep track of all your clients and who owes you how much, and that way who's taking longer to repay you and who you should be following up with. Maybe who's a good client to know for the future that consistently repays on time, and also who you owe money to, right? So if you have, again, those vendor relationships or supplier relationships, And if there's more than one, it's good to keep track of those transactions and those cash flows so you know who needs to be paid. And also, as part of our process for access to get a loan, we will need to see a cash flow statement together with your business plan. So hopefully all those reasons combined convince you enough to keep listening to this webinar and learn on why or how, rather. Hopefully we answered the why. Now we'll get into kind of the how. How do we build a cash flow statement and how do we think about this? So when we talk about cash flows, what do we mean? Just to simplistically lay it out, the way you can think about it is we've got cash inflows and cash outflows. Cash inflows is cash coming into your business, cash outflows, cash leaving our business. With the difference between those two representing our net cash flow. And hopefully in most periods, that's a positive figure for your business. That'd be a good thing. That means your cash balance is increasing period over period. But at the same time, we may have certain periods where we experience negative cash flow, and that's okay. That can happen. Some businesses have seasonality, and perhaps certain months they'll generate less revenue, or some months or some quarters you may invest in. Maybe you're investing in a website revamp, or you'll be moving into a store, and therefore your expenses suddenly go up, and you have a negative cash flow for 1 month. So that's okay. Temporary negative cash flows are okay to experience, but what you need to think about is kind of your overall cash balance and how that gets impacted, and how much cushion do you have to be able to absorb negative cash flows, so that you know what, maybe I'm okay for this month and next month, but I know that by month 3 or 4 I need to start generating positive cash flow, otherwise I run out of money. So which again reinforces why this planning aspect is so important. So examples of cash inflows: business sales, loans, credit, grants, investor equity. So these are all examples of cash coming into the business. However, it is important to differentiate between cash inflows that are actually related to the operation of the business versus cash inflows that are simply more of a financing cash inflow. So what we mean by that, out of these 5, ideally business sales is the best kind of cash inflow you want in your business. The other cash inflows, loans, credit, grants, investor equity, usually suggest that you need to tap into external funding because you currently can't afford all the costs your business is incurring, and that means that whoever is extending you that funding, maybe it's a lender, maybe it's an investor, usually they're doing so with an expectation that they'll get repaid, right? So if we're talking about a lender, maybe it's interest plus the principal repayment. If it's an investor, perhaps they want a dividend, or they want to be able to sell their stake down the road and be able to make a profit on that. So important to differentiate between operating type cash inflows and financing type cash inflows. Examples of cash outflows: capital investments. So these are usually big expenditures to invest in part of your business. Maybe if you're producing goods, perhaps you are manufacturing T-shirts or some other clothing item, then you need some equipment if you're the one actually doing the manufacturing yourself. Or maybe if you have a digital product or a service and you need to or perhaps you just want to promote yourself through a website, maybe hiring a web developer to build out that website, that would be considered a capital investment. It's usually investing in things that will last longer than a year and will help us kind of build our business. Variable costs are costs that usually move in line with our revenues, so we can think about things like staff, employees, or cost of our products. Perhaps if we have like an import-export business, maybe we're importing from abroad a certain product that is not available in Canada and we're looking to sell it locally. The more you sell, the higher those costs will move directly in line with those sales, because you sort of need to buy more goods to be able to sell them. Fixed costs are things that usually don't change period over period. Maybe they change after a year or two, but generally they're sort of fixed, and you know exactly how much you'll need to pay out. So things like rent, insurance, these are fixed costs, examples of cash outflows. And finally, loan interest, loan repayments. Again, these are financing type of cash outflows, meaning that they're being paid out not to somebody, a customer or supplier, or somebody that's sort of part of the operation, but an external funder that was able to extend you a loan or provide you with equity financing. So that's an example of that. Great. So now that we covered the basics, let's get into building our actual cash flow statement. When you're building a cash flow statement, you want to think of it in terms of 3 stages. The first one is business setup. This means, what is it going to cost me to be able to generate my first dollar of revenue? Next, you think about the profitability transition. So what this means is most businesses, unfortunately, won't be able to be profitable from day one. I mean, some maybe, and that's probably the exception more than the norm. But you need to think about the period until you will break even, meaning that your revenues will you'll generate enough revenues to cover all your costs. So the reason this is important for cash flow planning is in this transition period, when you're still not profitable and you're not generating enough revenues to cover all your costs, that means you're generating a net loss. And a net loss needs to be funded somehow. It means that it will be a drain on your cash balance. And you need to have enough cash set aside to be able to get you through this period until you're able to get to the final period, which is sort of this ongoing business operations period, which is when you hopefully are now generating positive cash flow, positive income, and your cash balance begins to grow. And maybe that cash balance you can use to pay out yourself, or maybe to reinvest in the business, or pay out investors. Various things you can do with a growing cash balance. But just an important framework to think about when you're thinking about cash flows, and how to think about the different stages, and how the position of your business might differ in each stage. So let's talk about each stage more specifically. So your business setup, again, what do I need? What do I critically need to get going from the ground and start making revenue, start interacting with customers? Basically, what do I need to have to get ready? So here we have a security business, which is this is actually based on a real not the exact numbers, but based on a real applicant that we had submit for starting a security business. She wanted to be able to secure contracts to for her and her staff to provide security services to various apartment buildings, condominiums, office buildings. So in her case, for her to set up and get started from day one, she needed, so under equipment here and installation charges, what she really needed is uniforms to make sure that her staff is looking professional and consistent. So just an estimate for what that might cost for certain staff size of 2 to 3 security guards. Then we have legal and professional fees and licenses. So this includes insurance. As a security business, you must have insurance coverage to protect you against any liability in case something happens. Perhaps there's a robber or a thief or a murderer that comes to the building, and knock on wood, something happens, and you want to make sure that you're protected from that liability in case anything happens. So that represents sort of the cost for insurance for first and last month. And then licenses and permits. To run a security business, you actually need to be licensed and make sure that you've undergone the training to be able to provide security services. So again, that licensing process takes time, and there's a cost attached to it. That's done through the province, so $300 there. Advertising and promotion. So that's kind of building a website to make sure that you're professional, and you can put it on your business card so that when you go try to get contracts, people can log into the website and see that what kind of services you're able to offer, and who your team is, and your kind of experience. And then you'll notice that there's another line here around contingency for $500. So this is good practice to get into, to always budget in, at least 10% of contingency. Contingency means backup. So just in case there's something you've underestimated, or you missed a cost, or something will end up being more expensive than you initially thought, it's good to have this contingency in place so that you can use it in case you do need it. So this is our business setup. So then we have our business setup, and if you recall, we had two other components. One being our transition period, which I'll come back to in a little bit. But I just want to talk about that third part. If I just go back for a second, we covered off business setup, profitability transition. So we'll talk about the ongoing business operations, and then we'll come back to the profitability transition a little later. It will make sense once you see the full picture at the end. So in terms of your ongoing business operations, I think a good approach that we'd like to sort of promote amongst our applicants is this bottom-up approach. And what this means is starting with your expenses and then going up to your revenue. Typically what we see from most entrepreneurs who are applying for an access loan is they'll go top down and they'll get really ambitious and optimistic about how much revenue they can make, and they're like, oh yeah, on the second month I'll definitely be profitable, and thereafter my revenues will grow exponentially because I think this product really rocks, which is great. It's good to have that positivity and belief in your business, because ultimately that's an important entrepreneurial trait, and we like to see entrepreneurs that are passionate and want to sell their product or service. But a more pragmatic way to go about this is to think about your expenses month to month, and then going back from there to say, okay, how much revenue do I need at minimum just to break even? And then you can kind of work backwards to see, okay, well, if I need this much revenue, then that means I need to sell a certain amount of product or a service, and then you can kind of start asking yourself, is it realistic for me to do that? And if so, how soon can I do that? So in this example, let's talk about a t-shirt business here, and just thinking about thinking through the expenses that we might incur in a given month or a given quarter. So some advertising here, perhaps using social media to put up some ads to promote your new t-shirt business. Some accounting costs, perhaps you're paying for like a point of sales software that helps you keep track of all your transactions. Then we have a rental cost, and perhaps you have a physical space, a physical storefront where you're selling these t-shirts. So this would be your rental costs. Telephone bill should kind of be part of your standard utility costs. Employee salaries, perhaps you have salespeople helping you sell the product, or perhaps you've got staff that are actually helping you design or produce the t-shirts. You'll notice here for owner salary, I kind of put 0 for now, and you can either think that this can either be part of employee salaries, or this can be part of kind of being more conservative in the short term and saying, you know what, I'm going to focus on making sure I can break even and become profitable first, and only after a couple of months I'm going to start paying myself a salary. I mean, this by no means does this have to be standard practice. It does really show commitment and how driven you are to get the business to profitability. But of course, if the business is your sole source of revenue and you still need to pay your bills and offer financial security, then you can show us kind of the salary that you'd like there. But at the same time, we like to see that you're modest about this and that you are really focused on growing your business and becoming profitable before you're paying yourselves a fat salary. Insurance costs, we kind of talked about this earlier for the security business, a similar idea here. And then loan repayment. So in this case, it might be access or it might be a different program. And again, a contingency, you can see that I'm including into the monthly or the quarterly budget as well, a contingency in case something goes off and perhaps I need to spend more money than I initially expected. Right? So we get to a sum of $5,625 as our budget, and let's just assume we're talking on a monthly basis. So how do we work backwards and think about how much revenue we need to generate to make sure that we cover off all our costs? Well, if we think about our t-shirt business and our t-shirt sells at an average price of $40, I can start using that price level and my monthly cost to figure out how many t-shirts do I need to sell every month. $5,625 in monthly cost divided by $40 per t-shirt, 141 t-shirts per month. What do I need to sell weekly in order to get there? 141. Say we have 4 weeks of kind of business sales, then we're talking about 36 t-shirts per week. And if you're open every day, you can kind of divide that by 7 and say, okay, I need about 5 t-shirts a day. So then you can start kind of thinking about whether that's realistic based on some initial market testing. And what do we mean by initial market testing? Hopefully before launching your business, you've had an opportunity to just sample and test the market. Maybe if you in the t-shirt business example, you've made 1 t-shirt or 5 t-shirts, and you tried selling them, and you saw, maybe you were able to get some customer feedback. You saw how interested people were. Perhaps you set up a booth in some exposition where people were really interested and came up and asked a lot of questions, and you sold out very quickly. Those are all really positive signs. But if you put a message on Facebook and with some pictures, and you struggle through selling those t-shirts in the span of a month, even if it's only a couple of t-shirts, I mean, those are some important signs you should kind of keep in mind. And when you think about breaking even, that should let you know whether that's a realistic goal or not, based on your sort of initial traction. And then you can kind of start thinking about, okay, how many, if I can't sell 36 t-shirts a week in my first week, that's okay, but is that something I can possibly get to in a span of maybe 4 weeks, 6 weeks, 10 weeks? Because perhaps I haven't quite mastered the design of the t-shirt now, but I feel like there is potential. So again, it's okay if that goal is not achievable in the very immediate term, but you need to be able to get there eventually to make sure that your business is profitable. Okay, so then taking it to the next level is, what if I want to project my revenues for the month where I am making a profit? So maybe I know that to break even and just to cover all my costs, I need, 141 t-shirts. But ideally, I want to get to a point where I generate $4,000 in profit. So how many t-shirts do I need to sell? So in this case, we take our monthly costs and we add $4,000 as our profit to that, and we divide by $40 a shirt, again, as our average. Perhaps we have several t-shirts, but $40 is our average t-shirt price. That brings us to 241 t-shirts per month, or if we divide by 4 weeks, 61 t-shirts per week. So then you can start thinking about this and saying, okay, well, I know that 36 t-shirts I could probably do in a span of a week or 2. I can get there, but 61, how long could it take me to do that? Maybe is that something I can do in 3 months and 6 months? So you can replicate this kind of analysis for every month or every quarter in your cash flow forecast. So if you're thinking about 12 months or 4 quarters, and a quarter is 3 months, then you can start thinking about what kind of profit level do I want to get to at each milestone, and therefore how many units or how many t-shirts, how many makeup kits, whatever it is you're selling, how many do I need to therefore sell each month, and is that realistic? So you're always kind of checking for that sort of sanity check for whether those profit targets are realistic, and if they aren't, then that's when you start kind of adjusting and paring it back, and saying, okay, maybe 241 t-shirts is not realistic by month 3. Let me push that out to month 8 in the forecast, and by month 6, maybe I'll aim for 200 t-shirts or 175. So always kind of working backwards to see what do I need to do in terms of unit sales. Is that realistic? If it is, great. Let me keep that as the forecast. If it isn't, let me pare it back, push it out a bit, and adjust accordingly. So that's what we kind of want you to keep in mind. Other things to keep in mind for your ongoing business operations, risk analysis. So you want to think about what could impact your business's costs or sales over time. So maybe if you're projecting your cash flows for 2 or 3 years, you want to think about your rent. Maybe you've signed a lease agreement for 12 months, but that could increase upon renewal. Perhaps there's already a condition stated in there that every year it increases by inflation or by a couple percentage points. Perhaps you heard rumors about minimum wage going up. That's something to keep in mind if you have minimum wage staff as part of your business. So maybe 6 months from now or 12 months from now, or whenever you think that minimum wage law might get changed, is when you need to reflect that in your cash flow forecasts. Maybe you have some seasonality in your business, right? So we talk about a t-shirt business. Maybe the winter time sales slow down significantly. So maybe sort of April through September is when your sales are really strong, and then you're showing in your October through March timeline, your sales are coming down. So it's important to kind of think ahead and think about some of those risks. And like I mentioned, you can sort of reflect those risks in your cash flow forecast by adjusting how many units you think you'll sell, and therefore kind of bringing your sales up or down, or your expenses up and down based on that. With a t-shirt business, maybe we expect a 50% reduction between October and February, for example. So we adjust those sales numbers in our forecast. Another thing you want to keep in mind, and we kind of touched on this briefly, is sort of transactions that are cash-based versus billed, right? So we may have different businesses where when we sell something, we may not get paid for it immediately. It may take some time until we complete our project. For example, a construction business may work on a project that starts in November 2018, but they only get paid for in February 2019. Or maybe a supplier that will send you goods during 1 month, but will actually only bill you in the next month, and that's when you will pay, or perhaps you'll pay 30 days after that. But for the purpose of cash flow statements, it's important to note that what we care about is cash. Again, cash is ultimately king. So when you're tracking your cash inflows and your cash outflows, you want to make it based on not necessarily when you were billed or when you billed someone else, but rather based on when the cash actually came to your bank account or came out of your bank account. I mean, that's the kind of timing you want to think about when you think about your cash flow statement. Okay, so if you recall, I said we'll come back to the profitability transition, and this is where we'll touch on it, because this is where we kind of have the full picture and what a cash flow statement looks like. So at the top, we start with a setup period, which we talked about in the very beginning. So we have some startup costs, $6,500. So here in this case, it's a bakery business. So we have some startup costs, perhaps to invest in some baking equipment that we might need. And to offset, to be able to fund that, we have the owner contribution. So perhaps this is the owner's savings of $2,000. There's $5,000 here in, the label is missing here, but that's probably the access loan there for $5,000. And maybe an additional $3,000 of other family loans that you were able to put together. So in total, you have a positive cash flow of $3,500 after your setup period, which is great. You want to start with a positive cash flow at the beginning, because as we mentioned, we have this profitability transition where we will need a positive cash balance at the beginning to help protect us against those losses in the first couple months. And that's exactly what we see here, right? So if you look at month 2 through 4, and you look at that red, what is circled in red there, net cash flow, we're not yet generating it. We're generating sales. You can look at breads and cookies and cakes that they are selling, but just not enough to cover some expensive costs we have right now. We have our operating expenses, which might be the dough and other ingredients for the food. We have some wages we're paying our staff. We have our access loan that we're repaying every month. So we're not quite there yet on generating enough revenue, but thankfully by month 5, we were able to grow the business to a level where we are generating positive cash flow, and that's when we kind of hit the green, or the third stage of the ongoing business operations. And there's some fluctuations there. Perhaps some months we're doing really well, but for example, in month 11, we could see that the net cash flow actually came down a little bit from 2,445 to 2,065. So maybe there was, some problem in the bakery. Maybe it had to shut down for a couple of days, or staff couldn't show up, and therefore sales were down. But if we look, the most important check to do here is when you look at the cash balance, right? The very last row of this cash flow statement. And you can see that, we get close to hitting 0 in month 4 and 5. So this could be a potential red flag when you're thinking about planning your business, and maybe you tell yourself, you know what, I may need another couple $100 just to make sure that I don't fall into the negative here, because basically negative means you're quote unquote bankrupt somewhere and to some extent. Because if you have a negative cash balance, that means somebody is not getting paid, right? So maybe that's, in this case, it might be your staff, maybe suppliers are not getting paid. But that's a really important point to keep in mind. The cash balance at the end of the month should always be positive every given month. And if it isn't, you've got a cash flow problem. And you need to think about either getting more money at during your setup period, so you're ready for those difficult that difficult profitability transition period, or you need to think about perhaps being more constrained with your costs. So maybe if you were gonna hire really experienced staff, maybe you need to think about hiring somebody less experienced that won't be as expensive to hire, or maybe you need to think about renting a different place that won't be as expensive. So then you need to start thinking about how can you be more nimble with your cost structure, reducing your costs. Great. So I think we're almost coming to our conclusion here, and I'm just doing a time check, and I think we're good on time there. So here are just to wrap up our cash management tips. So these are little things you can think about to stretch your cash a little longer, or make sure that you kind of turn those low cash balances a little higher, or those negatives into small positives. So ideally, when you want to shorten the collection period from clients, what that means is if you're billing, in the example, or maybe you're an accountant, or maybe you're doing some sort of landscaping project and you're billing the client, you want to make sure that you get paid as soon as possible, because the longer that stretches out, the more the higher risk you face as a business, because it's cash that you're not getting and you're still waiting on. So ideally, you want to try to shorten that period as much as possible. At the same time, clients sometimes do like to be able to finance sales, or be able to do that on credit and maybe repay you over a period of a few months. So it's important to balance kind of keeping the collection period short, but also making sure that you're not too restrictive to an extent that you may be losing clients. Increase your payable periods. So this is for suppliers. So it's funny because the tip is kind of the opposite way, that with customers, you want to try to get that cash as soon as possible. Well, with suppliers, you want to try to stretch it as much as possible. So hopefully you can negotiate for maybe 30 days or 60 days to pay them after you get billed. But again, there's always, with each one of these tips, we're trying to act in kind of self-interest and maximize our cash flow in our business. But you need to kind of keep in mind that your relationships with customers and suppliers. So in this case, you want to make sure you're not frustrating suppliers and you still are paying them on time. You can also increase prices, right? So maybe with that t-shirt business, it was going really well and things were selling out, and perhaps that suggests that demand is strong enough and you could charge customers more, right? Meaning that on every t-shirt, you're actually making a little more money. But again, you want to test your market and not be too aggressive. Maybe if you raise the prices to a point where customers are turned off and they think that's too expensive, and then you lose, or maybe you get a couple of customers that will be willing to pay that higher price, but overall you'll be worse off. Fixed costs, usually variable costs are a little more difficult to change because they're directly tied to our sales. But fixed costs are things that we may be able to see how we can kind of squeeze and reduce a little bit. So perhaps it's finding, if we're talking about a storefront, perhaps looking for a place that's lower rent, maybe renegotiating our insurance costs with a broker that is able to offer us a better quote, stuff like that. Again, you want to watch for capacity to meet sales demand. So if you're going to rent a different location, you want to make sure that it's still big enough to be able to kind of accommodate customers that are coming in, and or perhaps the location is really off given who your demographic is and where you're selling. So something to keep in mind, and also obtaining an affordable loan, right? So we hear some stories from clients who tapped into really expensive credit cards and lines of credit that are charging like 20-30% APR. So you want to make sure you're careful about that, and you do look into programs like Access, where we offer very reasonable rates, because that will make the the cost management side definitely more manageable for yourself. So yeah, that's it. Those were the tips, and we'll open it up now to Q&A. So please feel free to ask any questions you may have, and yeah, no such thing as a stupid question. A question you might be thinking about right now, so somebody else is probably thinking about as well. So yeah, please submit any questions you may have through the chat box. Okay, looks like still fairly quiet, but Michael, let me know if there's anything from your end.
Yes. Yep.
That's coming through.
Okay, so yeah, if you have any questions, please put them through the chat box. There is a couple of questions that came in, Ellie. The first question is someone says they are a small business entrepreneur, and they're wondering, is cash flow tracking something I can manage myself? It seems daunting, or should I be thinking about hiring someone else to help me?
Yeah, great question, and I can appreciate for someone that maybe does not have a a background in finance or accounting, this definitely can be intimidating. So what I would say to that is, I would say just give it a try and get started with it. I mean, we also have a template for cash flow for a cash flow statement on the Access website, and really just it kind of does the calculations for you, and you just have to input your different costs, which only you as the entrepreneur would know best. So I'd say give it a try. Get started with a template, and maybe reach out to Access. We've got mentors and advisors that can help you through that process. And if you feel like some things are getting really complex, and maybe there's something specific about your business which is not so easy to project or estimate, or then maybe it's appropriate to seek external advice and get someone else to do it. But I think just as a start, it'd be good practice for you to do that, just because as a business owner, it's good to be able to continuously monitor your cash flows, because I mentioned earlier that's a great way to track performance of our business and make sure we're meeting our targets, and we can ask questions and make decisions. So I definitely encourage to get started on your own, or with support from Access. And if things get really complex, then seeking external advice.
Okay, great. Thanks, Ellie. And you had mentioned the coaching program, and I'll just mention that our coaches can actually help people both at the application stage and after they've received a loan. And it's often at that beginning stage, it's really helpful to get that support and feedback, as Ellen's articulated really well in the session today. There is another question somewhat related. So the person wants to know, can I track this kind of information in a simple Excel document, or do I need to be thinking about using some type of software?
Yeah, I mean, I think Excel is a great place to start. Definitely that's what the Access template is based on. It's an Excel-based tool, so great place to start. I think where a software may provide value, where Excel maybe struggles a little bit, is being able to kind of hook up with your point of sale system. So if you have a very much a retail type business or a customer facing, where there's a high volume of transactions and it just gets too daunting to be able to keep track of that on a spreadsheet, because there's like 100 customers coming through in an hour, that's when it makes sense to think about a software that is able to keep track of those costs automatically when customers are paying with their credit card or things like that. But if you have a different kind of business where those sales are not as high in volume, and maybe it's a couple sales a day or a couple a week, then that's Excel is a great place to start.
Okay, great. Thank you. Just looking at the chat box. Okay, next question is, any tips to help with pricing a product or service, and are there templates available?
Yeah, good question. I guess the way I think about pricing is there is a cost element to it. So there's two ways to think about it. I mean, one, there's a cost element in terms of like how much does it cost me to produce that product or service. So the price has to, at the very minimum, has to cover that. Then you want to start thinking about a buffer to cover your fixed costs. So costs that didn't necessarily go into making the product or service. So maybe if we're talking about a t-shirt, then our fixed costs would be things like we talked about, like the insurance and rent. You want some buffer to help you cover those fixed costs. And then, on top of that, then you need to think about it. If there's still room, then you need to start thinking about what are other competitors doing in your space and what kind of prices are they charging. So we don't necessarily have a specific template for that, but I'd say that's, as simple as just kind of, if your business is not unique in a sense that there are other competitors out there, then you can just kind of Google around and just make a list of what those prices are and trying to understand why certain prices are higher and why some are lower. Perhaps there's a difference in quality or specifications of a certain product are different. So kind of making that comparison, that will give you a range of where the market is at and where you may potentially fit in based on your own product specifications and how you want to position yourself. Perhaps you're a premium provider of certain goods, or maybe you're trying to be a value provider, meaning you're trying to offer kind of the more of a lower cost play where you're trying to offer decent quality for low cost. So you kind of need to think about your own strategy, how it fits with other competitors, and then also checking against your own cost structure and how much at minimum do you need to charge to just cover your own costs. So hopefully that answers your question.
Okay, great. I don't see any further questions, so I think we'll wrap up. I'll just have you go to the next slide, Ellie.
Yeah.
Thank you, everyone, for joining us this evening. I will be sending out a very short evaluation tomorrow, and we'd really appreciate your feedback on this webinar, and it really will help us as we plan for future sessions in terms of looking at topics and content, and also the timing of when we hold the webinar series. If you have any questions for Access, or you have any questions about our loans program, you can reach out to us through our website by email, or you can give us a call. We'd be pleased to speak with you. So thank you for joining us this evening, and we hope to see you at either one of our future webinar sessions or at one of our training sessions in person. Good night.